So this conversation is going to take sections, and at the end of each section, Bisoye will do a bit of housekeeping and we'll check if you have any questions on the section that's been spoken about. If you have any matters you want to discuss, please raise them up at the end of every section. So this is our section. It's going to be in 9 sections. The first section is the end of the negotiation era, which is basically saying that time where, according to Peter, you could just work it. That's the Personal Income Tax Act previously. No, I don't have this liability of 3 billion. Now help me negotiate it, and then your 3 billion becomes 10 million, and then the tax officer takes on 2 million naira by the side, and everybody goes home. So what NTA and the new tax laws are saying is that we don't want that era of negotiation any longer. People should no longer walk into the tax office, and then the area of BOG as well, which is best of judgment assessment, where they'll just take all your incomes in your back statement and they'll slam it to you as those are your liabilities, go and pay it. Or people would come up with random invoices on their laptops and then they would say these are the evidence and contracts backing up certain transactions, basically saying I'm tax compliant. So basically saying that there is now a new system where we don't want you to be negotiating these things any longer. We want you to be compliant and following the strict letters of the law. There have also been conversations on, are some of these tax laws new? The truth of the matter is most of them have even been abolished. Most of the tax laws we had previously had been abolished. But what has now happened is enforcement, and they are enforcing it via data and technology. The whole objective being that there should be a clear track of information that is tested and verified and justifiable. That way there is misinformation is avoided, and then there's little or no room for non-compliance because the information is out there and it can be verified. So there's little or no room for disputes going forward. So the negotiation era, as I mentioned, prior to now, we used to have situations where taxpayers and tax authorities, either state or federal, would say that everything is negotiable. You go visit your tax office, and even certain people were lobbying to work in tax offices because, I mean, that's where the largesse was, that's where the loot was. You know, it now became a game of cat and mouse. I want to go work in tax office, so, and then when I see my tax officer, it will help me to reduce something. And we had people who were in just that tax office profiting from the system that was set up to be rigged and corrupt. But now we are saying that we now have a tax force office, and that you no longer need to go to the office to go and be negotiating or arguing. The information is there, the data is there. So now we don't longer have manual filing systems. That's why the e-invoicing system came up. And it's because they also understand. So something that you might be a bit of point I want to make is people might have these conversations and or listen to conversations like this and assume that I am in support of the government. I'm not necessarily in support or against the government, and this is what I mean. The law has been defined. Evasion or avoidance is no longer possible. So when you are now saying that the best thing to do is just apply the law. So when you now say, oh, I want to, if I do like this, maybe I can get away with 1 or 2 things. It's no longer the case. So the best thing you can just do is follow the law and, and be compliant. That's just the messaging from today. So the negotiation era is dead, and it's not just, this is conversations we're having. It's not just a summary of the tax reforms. It's going to be like a survival manual for the new reality where we are. So there is a need for improving the revenue structure of the country, and this is driven by technological integration and a shift in strategy. So we are no longer doing physical enforcement where you would see that FIRS, all of us know that FIRS logo now, that white stamp with the red cross where they will now put non-compliance in front of your door. The government will never follow you to argue again. So all those, please don't come to my office, or where tax officers will come in your bosses and they'll come. So for some of the oil and gas companies that I've worked in, you'll see tax officers come with bosses and they're coming to invade. We are going to close your door today. That is kind of gone now. So we are now doing digital enforcement. So even before the tax officer has sent you a mail to say this is your tax exposure and all that, they've tracked your revenue, they've tracked that of your spouse. So a taxable person in Nigeria, anybody above the legal age of 18 and is earning an income in this country, is now become a taxable person. And the moment you have an NIN, you have a JRB number. So your NIN and your BVN are now automatically linked to the Joint Revenue Tax Board. Someone was asking me a question last night on how can I get my JRB tax ID? And I said, just go into the JRB website, enter your NIN, and you will get your JRB tax ID. That's how automated the system is now. But then there's also conversations around, I have a JRB tax ID and I have a State Inland Revenue Service tax ID. What do I use? The truth of the matter is eventually the JRB will supersede all State Inland Revenue Service tax ID. But right now we have a transition phase where the JRB and the SIRS are now integrated. For certain persons who might have filed their tax returns and their personal income tax with LIRS, there's now a cell where you need to enter your JRB tax ID while you're doing your filings. So when you're doing your personal income tax filing, you now have your JRB as the ultimate source of data. But right now we're in a transition phase, and it's hopefully that soon the government will update its record and the JRB and SIRS will be phased out and the JRB tax ID will become the ultimate tax ID. Right. So this guide is basically for the entrepreneurs, the professionals, and the business owners who ask, how do I thrive in this new environment? Can I legally reduce my tax without going to jail? Basically saying, how can I do my tax planning appropriately? Can I do tax savings as against to tax evasion? So it's tax avoidance, not tax evasion. You know, tax evasion is actually against the law and you could end up going to jail. So, and then there are now questions on, does government really know my side also? And then what happens if I make a mistake? So the goal of this conversation is simple. We want to move from fear to uncertainty, confidence and strategy. So at the end of this 35 pages, you will understand how to structure your earnings, document your expenses, and defend your position so that you pay exactly what the law demands and not a kobo more or less. So quick reference to the shift between the old laws and the new laws. So we had this enforcement strategy before, as I mentioned, physical raids where they would show up in your offices and lock your doors. But now what we have is digital freeze. So people ask, what this digital freeze, is it automatic? The tax enforcement committee has come out time and time again to say that it's not automatic. The government cannot just they cannot just wake up one morning and you receive my account is frozen by virtue of NRS freeze. That's not what's going to happen. What's going to happen is they would have conversations with you, try to negotiate your positions. But then when they see that individuals are being, that is when the enforcement strategy, and it's again not automatic. They need to go into federal court because no Nigerian bank will apply garnishee order or a lien on your account by virtue of NRS said so. No, they would, because if they do that, you can sue the bank, right? So they would need to get a court order. NRS needs to get a court order. Now, when that court order is approved, it's that approved court order, which is called a garnishee order, that the NRS will then take to your bank or any banks that your BVN, and you know BVN and NIN has actually linked all our accounts really, that they will now use that to apply as a lien on your account. And that lien is basically saying, this person is owing us some money, we want it resolved. And then, after some time, if you still get avoidance and not tax compliance, they will start doing the deductions from the account. So it's not an automatic freeze on all accounts. They'll just freeze all my accounts. No, there's a process around it. So because the tax man also knows the law, because again, they're the ones that define the law, right? So there's a process. It's not automatic that it will just start your enforcement strategy. Now, before audit triggers, that's what we call tax dex review. They used to be random. They'll just select somebody's file, or especially the companies in the tech space. The moment they raise funds, right? That's what we usually have. That the tax officers can say, "Where's this person's tax file? You've raised money. Oh yeah, I want to go and collect my own portion." but they can't do that anymore. E-invoicing is there. So between my e-invoicing, my PIT declaration as a business and as an individual, data now drives audit. So it's when there is a significant variance between your expected tax filing and your actual tax filing that you can now have tax audits, really. So there's also the area of identity and data now being synced together. There's now a synchronization of information. How do I mean? Before, I could speak to businesses that I knew had significant assets, but then they didn't declare it, or even individuals. You could own acres of lands and assets and you would not declare it because you don't want the taxman to know that I have it. So you would have some properties somewhere, or you even have assets like gold somewhere, and you wouldn't declare it. But now, even the aboki that you're going to go and buy money from or gold from, he would need to file his personal income tax. So by the time he's filing that he has sold you gold and you are not declaring it as an asset in your PIT, there's already that inconsistency in filing and returns, which could trigger an audit. And then we know the invoicing that we now have. We now have the e-invoicing. So before, anybody could come up with their system, create an invoice, put any amount there different from what it should actually be, and they would say that's the contract, at least it's invoicing between two people. But the government has said no. And again, let's understand that this new tax act is based on an improvement of practices that they've actually seen when it comes to appliance and administration of the tax act. So now they say they want you to have e-invoicing on their system. So between the supplier and the recipient of any information, there is now that synchronization where your invoice is generated on the e-invoicing platform. That's the e-transact platform as well. And you now have it stamped by FIRS even before sending it. So you have your contracts, it's fine. But the invoicing that backs revenue to someone and expense to another person is now regulated and governed by FIRS. And the reason is they want to have one true source of data such that variances are easily identified, picked up, and corrected. Then VAT as well. So VAT is now treated as a debt to the government. So what we're saying now is that we now have VAT inputs and outputs that can now be exercised and can now be applied on your transactions as a business. Then withholding tax is also now a credit. So you can use your withholding tax, which we have for some certain instances before, but because the credit notes we had to get, right? You had a lot of unclaimed WHT. Even back then, you had financials where you'd say unclaimed WHT credit notes. But now your credit note is automated, so there's nothing like unclaimed credit note any longer. So it's treated as an advance on your cash payment, on your tax payments that you can claim and use it to reduce your tax exposure to the government. There was a time I audited a particular client where if he had gotten all the withholding tax credit notes, he wouldn't be paying any CIT to the government. But because the credit notes were not available, they ended up incurring some tax exposure. But that is no longer the case. And then we also have the all famous PAYE, which everyone is concerned about, saying how does this affect my gross income? How does this affect my take-home pay and all that? But now we have strict applications of your reliefs and your pensions and allowable deductions to get your taxable income legally and in terms of the new tax act. So what do I want us to take away? First off, the first five primary things I want us to take away from this conversation is visibility. The government now sees everything, from your inflows, from your outflows, from the ones that are in your receivables, from the ones that are potential, everything. They now have access to it. So your penalties, so you shouldn't under declare or over declare. Just declare the correct information, because the government is on government knows now. Then the penalties are now system applied. So there's no negotiation you want to have. Tax Promax is now automated. So there's no negotiation you want to have with any tax officer. And then there's also the fact that, you cannot, you cannot choose or opt out of being on Tax Promax. As a business owner, you would be on Tax Promax. So there's no way to avoid it. Then your invoices and tax clearance certificates are now server verified. Then when it comes to payments as well, your payments are also auto-generated because they are now auto-computed on the system. So inaccuracies that could happen has been removed. So the 5 core pillars of the new regime: visibility, automation, validation, a stricter process over payments, and the silence culture has been expunged. So your non-filing will be treated as intentional tax evasion and an acceptance of the possibility that you could face a penalty from the tax authority. So the invisible net. The invisible net is now saying how data and technology have replaced enforcement officers. So remember I was saying that tax officers that could knock on your door and expose you to certain obligations, it's gone. So what you now have is that the 2026 or 2025 Tax Act, which became effective in 2026, is now the invisible net. So there's an ecosystem of interconnected data points that the NRS and the SIRS now use to access your liability. So your NIN, your BVN, and your JRB are now linked. The integration is ongoing. It's not fully compliant yet, but it's ongoing to ensure that, you just have compliance. And again, the trinity of surveillance, as I call it. So your BVN, your NIN, and your TIN now linked together. So you could be Mr. A to your bank and Mr. B to CAC, but the tax office, by virtue of your BVN, your NIN, and your TIN, which is your tax ID number, are now synced together. And remember, your account number, you must have a BVN. Your CAC filing, you must have an NIN. And then you must even have a TIN, which is a tax ID identification number to register with CAC. So all this information is just linked. What they've done is they've created a connectivity chain between all this data source, just to ensure ease of validation and data access. So in your personal bank account, if you receive 50 million in your inflows, that's to your bank account. But then when it's now time to file your personal income tax, you go and declare 5 million. What the tax authority will just say is significant variance identified, and then there will then be triggers for an audit to say there's inconsistency in your data source. And then turnover versus profit. When people hear the government is about to tax me, they just automatically think, oh, it's on your revenue or it's on your gross income as a salary earner. But that's not the case. What the government is looking at is your profit. And what is profit? As a business owner, you know that it's not every money that comes into your hand that is your income. Out of your income, you would still deduct your expenses, you'd still deduct your cost of buying the goods, your cost of maintaining the business, to arrive at what we call net profit. So your net profit, could it be before interest and taxes or outside of interest and taxes? That's another conversation. So the NRS would not just look at your bank statement and see 100 million in credit and assume the 100 million is your entire income. No, they would take out your expenses to arrive at your net profit, and then that net profit is now what is now open to tax. So yes, you received 100 million, but here's the proof that I sent 95 million on business cost. So the system now approves that legally you million. So your deemed rate now your millions the gross profit revenue, as I mean. So the data tell your story. What does economic presence mean? Some owners and live in the same space, right? I don't have an office. I'm a remote worker. I don't have a signboard or information what I'm using. So significant economic presence is basically saying you have a business somewhere in Cross River State. You're living in Cross River State, but you're a remote worker. So when you want to file, you might say, I already make my money in Nigeria now, so why am I paying money to Nigerian government? The truth of the matter is, one, there is a tax treaty that Nigeria is signing with some of those countries. And two, you are a resident in Nigeria. So your tax is now being recognized by where you have significant economic presence. So where do you have a physical building? So you don't need to have a physical building to be taxed. You just need one, a sustained economic interaction with persons in Nigeria. And then where the person is resident in Nigeria, the receipt of income from anywhere in the world. So if you sit in Lagos and you earn $2,000 a month from a US company, that money eventually eats a Nigerian domiciliary account or is liquidated via a P2P platform, a peer-to-peer platform. So those are your fintech companies, your tap send, and so many out there. So you are considered to have a significant economic presence in Nigeria, which invariably makes you a taxable person in Nigeria. So the government is also working on with fintechs and crypto exchanges to tighten that connection. So you don't have P2P merchants that they're required to report high volume transactions. So the crypto loophole that people were taking advantage of to say, oh, I'm a crypto trader, I don't necessarily earn in Nigeria, that loophole is closing. So if you liquidated millions and you saved it up with some unknown agents and you think Nigerian government will not find out, really, how do you want to do it? So let's face this scenario. You have an account somewhere as a business owner and an individual outside of the shores of Nigeria, except you want to be traveling abroad to go and withdraw that money physically. And there's a limit to the amount of cash you can even carry into the country. There is no way, the moment you're sending it to a Nigerian account, that the government will not identify that this money is actually from a certain proceeds. So again, I say that tax evasion is not, tax avoidance is not possible. Tax evasion is rather not possible, but tax avoidance is. And really, you want to be compliant with the law and try to work within the doctrines of the law, because a penalty would, aside of the cost implication as well, it will create a reputational risk from you. There's also the shift from collections to compliance. So we know what we used to do then. If you pay tax government everything, any money, Jerry, they will just let you go. No. So they are trying to drive compliance, because they know your monthly compliance would dovetail into your annual compliance. So they now have that. You should file your PAYE on or before the 10th of every month. Your VAT and WHA as well now have their filing timelines and deadlines. So you should be compliant with all those things, such that at the end of the day, the bargaining struggle that we used to have before and the world of Oga at the top, let me go and speak to someone, is now a thing of the past. That's where the tax office is moving on to. So you're now living in a glass house. Your bank accounts, your land records, your travel history, and your corporate registrations are all transparent to the tax authority. The strategy of hiding is no longer a strategy. It's a gamble with incredibly poor odds. So a lot of Nigerian homeowners don't do C of O because they say to themselves, I don't want government to know that I own this property, so I won't register it. Is that property has a taxable income on it? Remember that your tenants will declare it as a rent relief. Outside of rent relief as well, if you're going to claim it as a place of residence for yourself, either via mortgage or even just declaration of where you live as well, you've invariably declared that as address. So they don't want you to hide, or they've even created little or no room for you to hide any longer. So why do you want to hide? What are you trying to hide? And then it's also to drive the supply of amenities to a particular area. By the time they find out that students or families live in this particular location and they're tracking it back end with the number of resources, amenities they provided in that area, they can properly allocate and now be able to identify areas that need societal advancements and amenities, and then improve overall living conditions for people based in that area. So section 2, this one is now for the salary earners and also people that pay salary, so employees and employers. We know we have run businesses. Some of us are what's called one-man business owners, where we self-employ and self-service the business. And then some of us are employers of labor, where we have 2-3 people working with us and we pay them. What government has done is that it has now said there are certain statutory reliefs you can take home to maximize your take-home pay. So they are now released on your pay slip So we know what we call gross income, which is your standard gross salary that is on your pay slip, right, or your employment contract. This is your gross income. But then outside of that, there's something called net pay, and your net pay is basically your gross income less your allowable deductions. So they don't want automatically, and I'm surprised, but I encountered someone the other day who said the gross income is what they just apply as taxable income, and that's not the case. The taxable income is your gross income less all of your allowable reliefs. As an employer, you should also know this, and because of this new tax act, there have been conversations on who would bear some of the changes that we are having. How do I mean? Someone is used to a standard net income of maybe 200,000 per month, and now there's a new tax act that says, okay, I should be able to apply rent relief. And then if this person has life insurance, I should be able to apply it, basically increasing the net pay to this person and reducing the payee. And to this question, I always say it boils down to the employment contract you have with your staff. If your employment contract is worded in such a way that you've guaranteed these people a certain amount as net pay, the cost or the additional cost will be borne by the business. But if your employment contract is worded in a way that it is basically your gross income is this figure, your gross income is 50 million, your gross income is 10 million, then is now that gross income you now apply the reliefs on, and then it's after that relief that people will now take their salaries home. So I say this again, if your employment contract is worded in such a way that what you've guaranteed your staff is a certain net pay, right? The business would be the one that would need to bear it, because they would need to walk back to get the additional costs that they would need to incur either by virtue of this new tax relief. But if your employment contract is worded in such a way that what you've guaranteed your staff is this is your gross income, then it's on that gross income that reliefs can now be applied, and then the staff will get their new net pay. So as a business owner, go check your employment contract, especially if you have employees. Go check your employment contract with your employees. What does it say? So your pay slip is now your source of clarity. It's now, so I'm sure not everybody here checks their pay slip every month for business owners or even for employees as well. Not everybody is concerned with what my pay slip says, because my pay slip is not what my pay slip is just a document, right? That's what we always say. My pay slip is not necessarily what I'm taking home. But what the new tax act has done is, and I like it, there are some applications out there that actually will give you access to your data, to your pay slip at the end of every month. At least I know Seamless HR does things like that, where staff would automatically get their pay slip. So you would be able to see the gross income, and you'll be able to see the deductions that your employee or your employer has applied on your pay, and then you derive at a position. Right. So this is the great misconception that gross income is taxable income. Not necessarily. Gross income is not your taxable income. Gross income is the total value of the contract. Then outside of that gross income, you now deduct your allowable relief. So things like your pension, NHF, NHIS, your rent relief allowance, your life assurance, your mortgage interest, all that come together to have what we call taxable income. Now, when we talk about the tax band, which is the first 800 being tax exempt, your next 2.2 being at 15%, and so on and so forth, to arrive at the eventual 24%, that tax band is on your taxable income, not your gross income. So please know this, that when you're going to compute your payroll, and I believe that HR professionals or accountants who are administrators of payroll should do this, that it's on the taxable income. So that taxable income, if you applied on gross income, what would have happened is that you would have underpaid your staff. Their net income pay would have reduced, and then your staff would also have excess to claim at the end of the year. So again, please, in case you might not know, to call the attention to the house to say that individuals now file taxes. So before, we just used to have it as businesses. Once my business has filed your gross income is now what you would be applying as your your tax, your tax rate on, right? So it's no longer on the taxable, it's no longer on your gross income less your allowable deductions to arrive at taxable income is what you'll be applying. So you only apply the tax rate on that final number, tax income, not on the gross income. So I was mentioning that individuals and businesses now file taxes. They now declare their taxes with the government. So any chargeable person in Nigeria, either below, so the fact that you are below the minimum wage as of now, or whatever, doesn't exempt you from filing. Even if you're below minimum wage in Nigeria, you still need to file your taxes. Anybody, any taxable person, and a taxable person is defined as someone living in Nigeria, living in Nigeria, and making an income from Nigeria, will need to file. So even if you're not making an income, let's just assume that something strange happened in the year and you didn't make an income, you will still need to file, even if you don't make 1 naira. Which again, let's be honest, is that really possible that there was no income to you for 1 year? But Nigeria has an unemployment problem right now, so possibly it's possible, but you would need to file, declare that you didn't make 1 naira. Every individual in Nigeria of a valid age and within the assumed that you have a taxable income, you will need to file. But if you don't even have a taxable income, still file, because that's the thing. If you don't file, you are now non-compliant and then you'll be owing a penalty. So best to just go ahead and file even though it's nil. Right. And then it's now what you get, which is your gross income less all your allowable reliefs that will not give you your taxable income. So a case study, we have 2 people. They both work in Lagos and they have the same gross annual income, which is 1 million per month. But somebody goes and applies the tax rates on their gross. Another one speaks to his HR, gets rent relief, has interest mortgage that he's applying the interest deductions on, and he applies voluntary pension. Also, your pension, per the Pension Reform Act, your pension contributions is also an allowable deduction. He does his NHF, does his NHIS, basically applies as much relief as he can. Even life insurance does it to say, okay, tax authority, this is the taxable income that I have, right? At the end of the day, one person's salary will be more than the other by virtue of the application of the law. So 1 million per month, as we know, the first 800 will be tax exempt. Then the next, again, this is on gross income, but your your taxable income after all those deductions is what you now have. The gross income after all those deductions, what you now have as your taxable income, and then the taxable income is now where you now be applying the relief on. The magic of rent relief. I know before we used to have this thing called consolidated relief allowance, but now what we have is rent relief allowance. So your rent will now be used to reduce your taxable income. Now this dispute, again, based on conversation. So sometimes in this conversation, you might see me going into examples that I have, and it's because these are practical examples that I've seen in my interactions with certain persons. Number one, your rent relief is not automatic. There are certain people who are living with dependents. There are certain people who have inherited houses. There are certain people who own their own houses. These people don't get rent relief, right? And remember that as a business owner, if you go ahead and apply rent relief on persons who shouldn't get rent relief, what have you done? You've underpaid PAYE. Guess who will pay the liability? The business owner. So rent relief is evidence backed. So there's certain things like even your mortgage, your life insurance, all those things, it's good, but it's not automatic. You still need to apply to the State Revenue Service or the JRB to say, I want to use this relief to reduce my allowance. I've also seen instances where certain HR persons decided that because of the confusion that currently sits with a lot of all these allowable deductions, right, they excluded it entirely from the payroll computation for their staff. And they said they leave it to staff to go back when they're filing their annual PIT with the government to apply for those reliefs, because then as an individual, you'll also be filing how much you paid as rent, and then your rent relief is subject to 20% of your annual rent capped at 500,000. So we know that certain areas rent is not as expensive. So when we gross up 500,000, which is 500,000 divided by 0.2, what do you get? 2.5. So meaning that if your rent is not up to 2.5 per annum, you shouldn't apply 500,000 automatically. what you should apply is 20% of the actual amount you are paying. So if you're an employee and you've gone to apply 500,000 for everybody in my business, please correct it next month. Next month, ask people to bring evidence of rent relief. And directly from Taiwo Yedele, he mentioned this himself, that what is considered as sufficient evidence to rent relief. So you have, what would a reasonable human say is allowable as rent relief? Number one, your rent contract. Number two, your rent receipts, or something as simple as your rent evidence, which is used for payments, which is your transfer evidence that landlord or property owner, I have paid for this. So that is what you now use to claim your rent relief. So rent relief is not automatic, but it's also good that you get the documentation, because remember that this tax law is now evidence-backed and documentation-backed. If you're going around to apply rent relief and you don't necessarily have the documents to back it, there is the possibility of a non-compliance with your PAYE computation, which could now invariably impact your business, because then you would pay the liability on it. So there is also pension. Everyone knows this, we had that before. By virtue of the Pension Reform Act of 2014, employees are required to contribute a minimum of 8% per annum as of their gross emoluments, where we've now interpreted to be basic housing and transport, but it shouldn't be. It should actually be the entire thing, but the law defined it as basic housing and transport by virtue of the fact that at the time that was what the public workers were using. Pension should actually be applied on your gross income, not on DHT, but that's a different conversation for a different day. There's disputes around, should pension be on DHT or should it be on gross income? So many employees, what you now have is that 8% of that, which is what we had before anyways, is a contribution from the employee. So it's out of my own, as an employee, I'm speaking as an employee now, it's out of my own money. So my employer should use that to reduce my tax relief, because instead of me to go home with 8% of my money, I'm using that 8% as my pension contribution. So it will now be used as a reduction in my allowable, my taxable income. There's also my voluntary pension contributions. Some people, again, the Pension Reform Act 2014 allows for voluntary pension contribution. So to optimize it, you can also do some voluntary pension contributions and use that as a tax savings to further reduce your taxable income. It's allowable in the law. So these are ways where you can, reduce your taxable income. How can I reduce my taxable income as an employee? First, your rent relief. Second, your mortgage interest on your loan. Third, your life insurance. Fourth, voluntary pension contributions, before we now go to the regulatory NHF, NHIS, and all that. Now, those regulations, another thing we had were instances of non-remittance, situations where employers were deducting pension and PAYE from staff, but they were not remitting to the tax authorities. Such will not hold any longer. If you're an employer and you apply any of those reliefs, the only thing you're not remitting to anybody there is our rent relief allowance, right? You're not remitting it to anybody. But your pension, you should remit it to the pension custodian. NHF, remit it to the NHF authority. NHIS, remit it to the pension, to the regulatory authority. ITF, remit it to the regulatory authority. You legally should not apply a relief and not remit it. The idea behind the relief is to reduce the taxable income, not to use it as a savings on your gross cost or your payroll cost. That money needs to go to whatever statutory authority you're deducting that money for, and you're being on their behalf. So health, life, and housing, the specific relief. So beyond the rent relief and pension, we have things like NHF and HMOs. So basically the premiums you made for health insurance for yourself and for that of your employees or for that of your family are now fully tax deductible. So many companies pay the HMO bulk fee, but they do not attribute it to individual staff on the payroll. So this means that the staff member loses the tax deduction relief. So the fix now is that your HR should communicate. So how do I mean here? I've seen instances where they do something called group life insurance. So that group life insurance will just apply to all employees in the business. So your HR has to communicate to you how much is your HMO that they are deducting, and how will this impact you. Remember, I said as an individual, you would be filing your personal income tax at the end of the year. When you're doing that, your PIT declaration, you will need to declare how much was deducted from your salary, either as an HMO or NHIS deduction. Then life assurance premium. In cases where you have your life assurance insurance on your life as a taxable person, that's as an income earner in Nigeria, the reliefs, all the premiums you pay is 100% taxable. The premiums you pay within a particular year. So if you have a life assurance that you started for purposes of illustration, possibly 2022, and you've been paying your premium per annum. Now, my 2025 premium that I paid is applicable for my 2026 relief. Now, when I go into 2027, my 2026 premium that I paid is allowable for my 2027 premium relief. Remember that your tax authority should, your life assurance provider should provide you something called a premium certificate, where they say declaration of how much premium you paid within the year. Then you take that to your SIRS to apply for what's called life assurance premium relief. Your SIRS should approve, and then you now qualifies as an allowable deduction. So these deductions are not just automatic, because again, they are self-declarations. So, and they need to be reasonable. How do I mean? You cannot say your gross income in your salary, for instance, is 50 million, and you now come up with, okay, life assurance, last year I paid, let me be ridiculous, I paid 30 million as life assurance premium. There will be questions on how did you survive on 20 million per annum if your salary should have been 50 million? Or do you have other sources of income that you're not declaring? So do you see the point I'm trying to drive here? Tax evasion, they've removed it. Like they've gone, no, we don't want you to hide. Don't hide. Declare the thing. Declare. That's what the government is saying. They want you to declare. So you cannot avoid tax at all. You can't. Tax evasion is now a clear law. It's a clear breach of law. And they said we would tighten the noose. Yes, the government has tightened the noose. I'm not going to lie now. We will tighten the noose that you cannot hide. No more hiding space for you again. Because what people were doing was they were saying, how can I get away with paying? How can I reduce my taxable income? Really, that's the conversation we are having. Okay, let me go and take mortgage somewhere and now do 100% mortgage. No, the mortgage is just on the interest on the mortgage and all that. And before you can even get mortgage, it must be a property that has C of O. So invariably, you've registered property already. So just closing all the loops, and now there's a 360 communication on information where you can now track source and then track application. The famous table that we've all seen at least once or twice online, right? So the graduated tax table. So what are we saying here? Sorry, again, forgive me. Sometimes I'll go into the chat. So I have some questions here where they say that is life assurance premium deductible? Yes, it is. Life assurance premium is 100. No, non-life. Oh no, non-life isn't. Non-life isn't. It's just life. It's just life. So life is the one that you take out on yourself. So I guess it's the way of the government. So non-life. So non-life, like your education plan or your car. No, those are not deductible. It's just life. Life is the only one that we can apply relief on. Right. And then remember, it's not automatic. You still need to go and meet the revenue service to apply for approval to use it. It's funny, but really, it's their own way of ensuring compliance, because they know Nigerians being Nigerians, nothing stops us from getting some random certificate somewhere and saying, okay, this is my reputation. They know the Nigerians' reputation, right? So just to close the loop, we must approve any relief. You can apply as much relief as you want, no wala, but we must approve it before you. It's not automatic. So you should always verify. Again, this is the current tax bands that we have in Nigeria today. It's not automatic, but you always be updated and verify it. So your first 800 of your taxable income. I keep saying taxable income because I've seen so many videos on TikTok, on YouTube, where they just go income. And they are omit that word taxable. That word taxable there is the key, it's the one that binds it together. That taxable income, you have to know what it is, you have to apply it. So your first 800 of your taxable income is tax exempt. Then the next 2.2 is applied at 15.5%. So not saying automatically, let's assume you earn 2.5. If you earn or let's make it simple, if you earn 2 million, if you earn 2 million, the first, as your taxable income, not gross income now, taxable income after your gross income less all those release and things that we've spoken about, your first 800 is tax exempt. The next 1.2 is applied at 15%. Right, that's for people who earn between 0 to 3 million. Now, if you earn above 3 million, let's say 400, is your taxable income. Out of that 400 that is your taxable income, the first 800 is tax exempt. Your next 2.2 out of that, which is 2.2, right, will be applied at 15%. Then out of that 4 million, if you take your 800 plus 2.2, you get 3 million. 4 million minus 3 million, you get 1 million. The 1 million of that, you apply tax at 19%. Such and such is not the application. And it's really simple. So what you now have is not just, automatic 24% on everybody. No, your average tax rate is now closer to somewhere between 17 to 18% on an average. And I've seen this because there's a practical payroll file that I have access to as well. The largest is maybe 22%, but it's not automatic. And it's because those are people in the high bands. So the higher you go, the higher the average, really. So when you're averaging your tax rate on your personal income tax, you would apply that band. So the minimum tax rule is gone. So before, we know as a business owner, even if you make a loss where your business was struggling and you were not, it was not a good year economically for you, they will still say, is it like, come and pay me my minimum tax. So that is gone. So you don't have that 1% of gross income where they would apply 1% on your revenue. No. So now the current structure is minimum tax is gone. Now, BIK, this is the one. Excuse me. I'll bring this up. Benefit in kind. The benefit in kind, as an employee or an employer, basically says benefits you get from working in your business. So things like your car, your business buys you a car in your name, not in the business name. Or they are paying for school fees for your children, or they are even paying your house rent, all those things are now taxable. And it's because the taxman has seen that the average Nigerian before used to restructure their payroll in such a way that they would manage the payroll, where significant portion of that payroll, that exactly as an employer now becomes BIK, and they'll say BIK is not tax exempt. And the taxman will be looking at you like, so where am I supposed to make my money from? So now they've refined it. So if you do things like your 13th month bonus, your reimbursable expense that is not backed, that's another point I will make, your reimbursable expense, right? That is not backed by, evidence and such. If you do any form of tax evasion on your payroll, the government will never follow you to argue. They'll just wait till year end when they are doing your PIT declaration. And let's not forget that the employee will declare it. So how do I mean? This employee gets a bonus and you call it Christmas bonus. Or you even call it reimbursable expense. Let's use that common one that we used to call reimbursable expense. And reimbursable is allowed up to 20% of your gross income, right? No problem. Employee, let's say you earned 1 million as your tax gross income in the year. No problem. 20% of that becomes what? 200,000. Okay, that's your Christmas bonus. Employee, bring all the expenses and receipts that ties to this 200,000 now. And then the employee submits it. And then as the employer, you now go, it's reimbursable expense of 200 million. No problem. Employer, bring all the receipts that ties to this 200 million. And you do it year on year. And the figure is the same, 20% exact. What the tax authority will do is they will just see it clearly as a tax evasion tactic, and they would apply what we call, what's it called now, penalties and back taxes on it because you falsely declared your payroll. So what have you done invariably? You thought you were being smart, trying to reduce your tax exposure, but at the end of the day, you're now going to have to pay for all those all those misstated payees that you've done in the past. And the payee is not just on your automatic pay alone. It's not just on the under deducted or under remitted amounts. There's now a penalty that you pay at the CBN prevailing rates +2 or something like that. And the previous CBN rate right now is 27%. So by the time you're applying 20%, 27% on as a penalty and back tax, at the end of the day that you've put yourself in trouble as a business owner. So just comply. Just comply. That's just what I would encourage any business owner in this meeting today. Please just comply. Compliance is the only thing that would save your business. So things like your BIK, you're paying for your staff's school fees, or you're paying for school fees for their child, or you're paying anything, pay should apply on it because it's a benefit in kind that you're paying. Your BUPA allowance. I mean, I know I'm calling things that business owners here might ask yourselves that what, but outside of this meeting, just to be knowledgeable when you encounter certain scenarios, right? To say, oh, BIK, any benefit in kind is invariably payee applied. Payee should be paid on it. Now, whether it's the employee, whether you deduct it from the employee before making that payment, or you bear it as an employer, that's again a business decision that you should take, right? Yeah, benefit in kind, BIK. So, summary of this section. First, the action items I want us to take here is check your pay slip. So the rent relief allowance, which is 20% of your annual rent, capped at 500. Remember, I said it that if you're not earning up to 2.5 million, if you're not paying up to 2.5 million per annum as rent, and you see that your employer has gone to apply 500 for you, your employer has done the wrong thing. Excuse me. If your annual rent is not up to 2.5, if you're not paying up to 2.5 as rent, please go back and instruct your employer to apply the right amount for you. It should be 20% of your annual rent. So if you pay 1 million, 20% of that is 200,000. That is what they should apply as your annual rent. If your rent is not up to 2.5, check your pay slip. Did my employer apply 500 for me? Also, did you provide evidence to your employer to back it up? And the whole objective of this rent relief thing is declaration of income on rental properties. The government will have the owner of the property declare their rent as their rental income. Remember that property owners will pay WHC, right? Now, if the owner is declaring 20 million as rent and you as tenants, you've gone to give him 30 million, no problem. Now they'll come and audit the owner and the owner will give evidence of this is what is my rent. And then you as the tenant that has gone to over or misstate your rent relief would now be the one who would invariably expose your employer as having applied the wrong rent relief. And then, so they've intertwined and interlooped everything. Everybody will self-declare, everybody will self-assess, they'll self-review. If there is a misstatement, they would do an investigation and then they would correct. Whoever needs to pay the penalty will end up paying the penalty. Right? So let's just do the right thing and make sure that you have evidences and documentations to back all these things up. So are you claiming your assurance and NHIS relief, life assurance? Understand that the new tax act is progressive. So by ensuring that these three things are correct, you move away from being a passive victim of the payroll system to an active manager of your own wealth. But salary is simple. The real danger and the real scrutiny in 2026 lies not what you earn, but in how you live. So in this next section, we want to talk about your lifestyle audits. We know in this world and age of social media where there is that drive to want to be in the good, to want to present as though life is beautiful, life is good, you need to be extra careful. Because if you go and false declare, there's this thing my people call false gold, which is basically panda. If you go on social media and you're blinging and saying you're popping, no problem. The tax man will just come, I see you blinging and popping on social media and you're declaring that the thing is not blinging and popping. Make it make sense to me. So that is what we are here to talk about, right? Basically saying your lifestyle has to match. So lifestyle audits are now talking about your rental cars and the unexplained wealth trapped. So this was about the science of tax, the math of your payslip. So in section 2, we talked about the math of your payslip, and now the section 3 is talking about the psychology of enforcement. So for decades, the NTA, which is the Nigerian tax system, operated a don't ask, don't tell principle. So a man could declare an annual income of 5 million, yet you live in a 200 million house in Maitama, you drive a 60 million Range Rover, and you fly your children to London for summer every day. Shebi is declared now. I declared that you want me to declare. So there was no check on whether it was accurate or whether it was correct. At least he has declared. Remember, I said 214 people ended up paying above 20 million, meaning most people, like maybe 99% of the population, paid on that declared tax. But I failed my PIT, so the government should not come from me. So now what the government has done is they've closed the loophole. So you have to declare the correct thing. They are looking at your expenditure. So your expenditure and your income has to match. If you remember the illustration I gave as well when I was talking about payroll, where I said in some instances, people were doing life assurance and they were coming up with ridiculous figures. There has to be a reasonableness to whatever you are presenting, and a reasonableness to a common thinking man. Like, okay, does it make sense? If it doesn't make sense, I'm sorry, it just doesn't make sense. Yeah, there's something you're not telling me, and they would know because they have access to your bank statements now. They have access to your NIN, they have access to your BVN, they can track your income sources. So if you spend 50 million this year, but you declared 5 million as income, no problem now. The remaining 45 million is unexplained wealth, Abby. No, and I will tax it accordingly. So you cannot evade. So there's often this significant penalty with tax evasion because they're trying to discourage tax evasion. So the real estate trap, I said, where your house snitches on you. So remember I said your tenants will self-declare what their rent is. And again, Nigerians being Nigerians, I've seen these conversations happen where people say, no problem, now I'll have 2 rent agreements. I'll have one with my tenants, and then I'll have another one that I'll tell my tenants, go and give the tax authority. No problem. The day your tenant go and gives the wrong one to the tax authority, problem. The day they check your bank statements and they see that the income is not matching because, for instance, you've gone to say under 10% or maybe a significant portion of the agreement is what you have in the other agreements. Oh yeah, explain how that money came into your bank account now. You now be looking, or let's use the famous one we call it. You now say it is gifts. No problem. You would explain whether you're a charitable organization and you're getting away with all those gifts, or the fact that, the fact that the other person as well, the person that gave you the gift, is not an allowable relief to them. So if the extra income is coming from a relative abroad, again, remember I said there has to be documentation for it. So if the extra income is coming from documentation and relative abroad, gifts from relative abroad is not considered taxable. But there has to be significant documentation to back it up. If you are just collecting, let me paint a scenario. Your what's it called? Your relative abroad is giving you $2,000 per month. Why? That's the next question. The person is just being magnanimous. That person is also exposing himself to tax review and tax audit in his country of residence. So there has to be some reasonableness to it. It has to make sense to the tax authority. Or it could be that you as a Nigerian here are earning income and then you've made your relative abroad the beneficiary of that income because you're trying again to avoid tax. So the important thing is just comply with the law and as best as possible avoid tax evasion. Because at the end of the day, there's really no hiding room, right? So the government is within its rights to try to, as I said, the other person that is giving you a significant portion of income from abroad, they would review that person's source of income, and if they notice that that person has any undeclared source of income, you as the beneficiary or recipient of that maneuver would be liable for some tax evasion penalty. So when you buy a plot of land now, you will need your TCC, you need your TIN as an individual. So the system, before we could do that, you could just pay cash and you're now a landowner, no problem. When you want to register for your C of O as a landowner, you will need to bring in your tax clearance certificate, basically saying that you've complied with all your tax remittances. That's to the Land Registry Office. And I've seen this happen before. Any land registry office, you definitely need your tax clearance certificate and evidence of pay, remittance, and deductions. So even if you're not a non-resident, anybody that wants to make any significant land purchase in Nigeria and you're applying for your CFO, so to process your governor's consent or register of deed, you must provide your TCC and your TIN. So school fees audit. This is for the middle to upper class individuals. So do you pay school fees to your children in top schools in Abuja, or you send them offshore, Lagos or Abuja, or you send them offshore for education? So when the top schools are now compelled to file detailed returns. So if your school charges 4 million per session and that means you have 3 kids, you're paying about 12 million per year, but your tax return says, oh, I just earned 8 million. You flagged yourself, you've reported yourself. How are you able to afford your cost of living? Your cost of living and your income are not in the same band, right? So every time you use the official Form A to purchase FX or school fees for your child, you're handing the government a receipt of your spending power and your spending capacity. So the CBN database now shares the database with the FIRS. So if you're, I love this response. So the person that answered, my uncle paid the defense, no longer works. So your uncle abroad paid the fees, no problem now. The burden of proof is on you to show that the inflow is from your uncle. So if the fees were paid from your account, my uncle paid it excuse is no longer allowed, right? Now, the vehicle registration as well. So the Vehicle Registration Office, the Vehicle Inspection Service, and FRSC are fully registered their database with the tax authority. So when you register that, I just got a car and my car cost XYZ million, no problem. How much is your minimum tax? And you now set up your tax. You plan your tax in such a way that as an individual, I'm below the minimum wage. They will ask you how. So basically, they've closed the loops, as I've been saying so far in this meeting. There's been that integration of source and expense. Your inflow and your expense just have to make sense. So you use I don't keep money in the bank, I use crypto excuse. No wahala again. They are currently integrating a lot of the P2P platforms. So any suspicious inflow that cannot be tracked or expensed again, they will just assume that you're trying to evade tax. And as you're saying, so far, tax evasion is not encouraged. Just tax avoidance and proper planning is what we are speaking here. So how to survive a lifestyle audit. One, you should how do you protect yourself? You cannot stop buying houses or kids, but you need documentation. Documentation is a lot of data storing or cloud storage platforms now exist, from your Google Drive to your OneDrive to even your emails. Documentation is now your way of protecting yourself. So when you borrow money, it's not an income, but if you bought a house on mortgage or a loan from a friend, you should need to have a loan agreement and proof of the repayment terms. So when you sell an asset as well, if you sold a piece of land or whatever, you need to have the capital gains tax may apply. So you need to know that it's not a new income, but it's a pre-existing asset. So there needs to be documentation to back it up. Gifts in Nigeria are not taxable in the hands of the receiver, but you must prove that it's a gift. So a notarized deed of gift from the donor is the gold standard. Documentation just needs to fly a lot in this new law. So if you spend money you've earned and you pay tax on 5 years ago, it's still legal, but you must show the paper trail. And there's a reasonableness to this paper trail. So if you're filing, if you've done your what's it called now, if you've done your gifts and donations, rather, what you would need is a document, right, to back it up that this is a gift and donations. So if you spend more money than you've earned, the tax authority will see it as a clear tactic for tax evasion, and you will be exposing yourself to a tax audit. The amnesty window. So at least this I still saw an headline today. The deadline for filing for your business returns was 31st of January, 31st of January, which is today. But the government has extended it by an additional 7 days. So the government is allowing people to do the right thing now, which is why there's a lot of noise on social media on tax compliance. So you should not have to wait until they now come for you to say you are non-compliant. there is that room to self-declare and self-access right now as a business owner. And as an individual, you have to, the 1st of March, to also file your taxes and to submit your returns on the relevant state revenue service, LIRS, for those living in Lagos. You go to the LIRS portal, you file your tax returns, and you submit. What are you filing your tax returns? You're basically filing your income and your expenses. If you need any assistance and support to file your LIRS declaration of your taxes and all that, just reach out to me outside of this meeting on any of the social media platforms or via email, and we'll see how we can assist and support you. So, summary of this section. So the days of fake it till you make it is no longer valid. If you fake wealth on Instagram or in the land registry, right, the taxman will treat it as your real wealth and they'll bill you for it. So that fake life might just be costing you some tax exposure. So you need to audit your public blueprint. Does your car, house, and school fees and your living expenses, do they match your tax returns? So document your inflow. So if your aunt sends you 5 million, get an email from her saying that it's a gift, so it doesn't look like it's an income from you. Get something to back it up. Documentation is what will save a lot of people from BOJ exposure and paying excess tax exposures, right? So you need to also ensure consistency with your story. Your personal bank account inflow and your tax clearance certificates, they should tell the same story. So in the next section, we'll now be talking about the business. How will you dissect the consuming alphabet soup of CIT, VAT, and WHT? Right. I have a question in the chat box. Someone mentioned that if I'm 50 years old and I have filed PIT, are the penalties waiting for me, or can I just start on a clean sheet? Now, Raphael, so if you've not filed your PIT, I would say start today. And the reason why you need to start today is if you start today, at least the one of old will not come and meet you, right? But I would leave it to the tax authority to advise you on whether you have any back taxes. But what you need to do now is file your PIT for 2025, and you have to 31st of March. So if you are waiting to say, okay, because in the past I've not done it, I'm not going to. The thing that has happened now with this new tax act is awareness. A lot of awareness is now coming out. I'm going to give an example. My auntie who lives in the village naked, she doesn't know anything about filing PIT now. I'm sure she has also never filed PIT as well. But now conversations are now, please go and file your PIT for this year. Now the government will advise us on whether they will be exposing or they'll be reviewing people who had previously not filed their PIT in years past, or it will just be starting on a clean sheet. Now, for individuals, for people who earn remotely, that is a separate conversation because the primary focus here is on business owners and businesses. So how do you reconcile in a situation where your income is straddling 2 states? Do you pay in both states? I said it, that this tax conversation, and I'm really liking this question. Thank you so much. Keep it coming. It's really loaded because I still had this conversation yesterday with someone where we were saying that he's basically a transit worker where he spends 2 weeks in one state and then 2 weeks in another state and all that. So do you pay your rent? Do you pay PAYE in both states? The question now becomes significant economic presence. So where do you live? Where do your family members live? Where do you have significant economic presence? See, that significant economic presence is your friend when it comes to which state do I pay my PAYE to? Well, which states do I apply my taxes to? Remember that the whole idea of tax is bring money, individuals or taxable persons, bring this money to the government. Let the government now use that money to develop the states. So the JRB will now allocate it to persons based on their contribution. So if one state contributes 20% to the pool, it's reasonable to assume, again, they've not advised us on the allocation on how JRB will be applied, but it's safe to assume that it's based on your percentage of contribution that they will apply it. Now, for an itinerary worker who works in 2 or 3 states, how do you now apply it? It's the place where he has significant economic presence that will apply. Because by the time you are saying, I want to break up, okay, maybe 1/3 of my PAYE contributions for the year will go to the state I was living for this time to this time, and then another time it will go to another state, you are already creating confusion, because that means, will the person be able to appropriately show that he was living in all those states for over those periods of time? And for the person who asked for this presentation slide, please be assured that you'll be getting a record of this, and then this video will also be uploaded on YouTube and social media platforms afterwards. So please, you can feel free to watch and get more information. So can you file your PIT online, or you must go to LIRS office to do it? Actually, you should file online. There is a website for this. So the LIRS has a website. I'll be putting out a video on that in the online, where you can now get. Exactly. Thank you so much. So there is an e-tax platform where you can just go and you register and you file. So some persons are not registered on LIRS. That's another conversation. LIRS is not automatic. You have to file to be registered with LIRS and all that. Provide your BVN, your email address, and such. But go to their website, LIRS website, and you file your PIT. So your business battlefield, your cash flow. If you're an employee, your tax file is relatively linear. You earn, you deduct, you net pay. But if you run a business in Nigeria, your tax file is battlefield. You're surrounded by acronyms such as CIT, VAT, company income tax, value added tax, withholding tax, education tax, ITF, and NSITF. Sorry, I'm going back to the chat box. What are businesses? Can it be filed online? Yes. I still filed for a business online yesterday. Online, everything is now online. You don't necessarily need to go to. Thank you so much, Mr. Samson. That's the website where you file your taxes. You don't need to go to a tax authority to office to go and file it at all. No, you can file online. You should file online. So many entrepreneurs, they view these acronyms as cost centers. So money that government is taken from them, and then the mindset was dangerous. So what then happened was that people were now doing tax mismanagement and trying to save their exposures, right? So we're now going to talk about this demystifying CIT and value added tax and WHT. So the objective is to show you that WHT is actually your money. VAT cannot be used, is a debt, and you can collect it back from the government. Then CIT is based on how well your documentation is as a business owner. So CIT, the first thing to understand is what we had before. So they assumed that not all companies were born equal. So before, you had small companies where your turnover was less than 25 million, CIT rate was 0%, and that means that if you sold, the famous rule, should I register my business as a business owner? Should I do business enterprise, or what's it called? Should I do a limited liability company? I answered this with a question. As a business owner, what tax do you want to apply to you? If your annual revenue is less than 100 million and your total assets is not up to 250 million, you get a CIT rate of 0%. Or do you want them to apply your Personal Income Tax Act band, where they're going to be doing your first income of 800 is 0, your first taxable income is 0%, your next 2.2 is 15%, up until 24%? Or you just want to take advantage of the simple one of, I'm a small business owner and my tax is and my total revenue for the year is not up to 100 million, because that's what we have now. This is still the old one. If your turnover is less than 275 million, you didn't need to pay anything as a tax exposure. That is the answer to the question. As a business owner, what tax do you want to be exposed to? Do you want to be exposed to tax as a limited liability company or as an individual under PIT? That answer is what you should be holding to say, what do I want to apply to myself as a business owner? Do I want PIT to apply to me or CIT to apply to me? A lot of people go, I don't want to register with CAC. The process of registering with CAC is difficult, it's challenging. It's actually not. CAC registration, I've done CAC registrations at 1 a.m., 2 a.m., and then the numbers come out the next day when the tax office. It's automatic. A lot of these things is technology driven. So if technology is doing the work for you, why are you not taking advantage of it? So consider having, my personal advice when it comes to that great debate, should a business owner have a PIT, or should a business owner have a limited liability company or business name? My great advice is always do business name. However, be able to immediately identify which one is your company expense and which one is your personal expense. How do I mean? You're a business owner, you're working from the same house that you live in, right? Let's say it's a 2-bedroom apartment. One of those places is your store, used for storing your materials. The other one is your office. and you hold certain meetings in the parlor, do you know invariably and maybe you live and sleep in the parlor, invariably you said over a third of your rent is just for business expense. So you should have what's it called, be able to identify which one is my personal expense and which one is my business expense. Because when it's now a business expense, it's now clearly allowable and you can now use it for your tax savings. But if it's a personal expense, it's not allowable for your business deductions, right? So so when it comes to your CIT, right, as a business owner, please go and register with CAC. And you can easily upgrade, because there's also been another conversation I've heard. People can say, oh, but that business name might now not be available again. The wonderful thing about running a business in Nigeria, do you know, is that you can have your name registered with CAC as ABCX and Co. And then your bank account, you can still operate that business name as the bank account, because that's another fear I've also seen. People have been saying, that means I need to change the bank account name now because the bank account name will not match that. Not necessarily. There's a registered name with the government, and then there's now an operational name that you're using for your operational day-to-day activities. So you would still be filing CIT as a business, but your operational activities. So how do I mean? For instance, ABC Limited is already registered with the CAC, right? But then your bank account, because you've been operating it for 7-8 years as a business name, is possibly B Limited or B Company or B Business. You don't necessarily need to change your bank account because you are upgrading to an ABC. You should change, but then what you're having is an operational account that you're using for your day-to-day activities, and because you want to keep your track record of your data. It's still allowed. And I know a lot of businesses do this, a lot of consulting firms in Nigeria. So a lot of businesses in Nigeria now have what's it called, 2 sets of accounts. The one that is my limited one, that's the one that is the government. That's the one I register with the government, and any business activity. So if I'm preparing my accounts, what would I prefer it under? ABC Limited. But my bank account name, you don't need to necessarily change, but please upgrade. So there is what's it called, compliance with the law and still protecting your business. So still talking about the old threshold, right? This old threshold was turnover below 25%. And the benefits, if you sell less than 25 million worth of goods, you pay 0 taxes, but you must still file your returns, right? You cannot just stay silent and say, oh, it's nil returns. No, you need to show your track record, because again, I've seen people go to tax office and they'll say, I'll just file nil. No, you don't file nil. File what you actually earned, right? Because your bank record will still speak that information. So this is tax law. Right? The new tax law, your turnover has to be greater than 25%. Sorry, that's not contained in the slide, but your turnover has to be greater than 100 million, and then your total assets needs to be lower than 250 million for you to qualify for a small minimum tax act. Then your legal entities or large companies that are now companies with a greater turnover of 100 million. So once you cross that 100 million threshold, and really everybody wants to cross that 100 million threshold, everybody wants to be big. That's the purpose of doing business. Everybody wants to make it big, right? So if your intention is to make it big in life, have a track record and have a track history of compliance with your tax laws, because when you are either applying for a loan or getting funding, there'll be conversations on what is your history with tax compliance. So if you have a history of non-compliance with the tax laws, it doesn't necessarily benefit you. So we talked about the deemed profit danger. The deemed profit danger will be mentioned in section 1, but is that the CIT is charged on profits, not necessarily on turnover. So if you sold 50 million, but you made a loss of 2 million, you are minimum tax. Minimum tax is minimum tax is now a thing of old. There's nothing like minimum tax again. You pay 0% tax, but you still need to file. So you all need to always file your audited accounts. Even if you made a loss, please still file. So now talk about the VAT is understood in Nigeria. So I think I see a lot of these things, and I was still mentioning to someone the other day, where your VAT, you say my bank account is just charging me VAT. Why are they charging me VAT? Guess what? There are a lot of allowable and tax exempt expenses now in Nigeria. So if one of your expense is VAT. You use your you can use it to deduct your tax remittances. So remittance, your net what's it called, your net tax payments to government is VAT output minus your VAT input. So if at the end of the day your input is greater than your output, guess what? The savings from the government to say that I incurred certain things like your bank charges, consider it as VAT inputs because you collect it now from the government, right? And say that my VAT inputs should be deducted from my VAT output, and then you would now less it to your tax payments to the government. So if you're going to pay government, for instance, 10 million, and then you take out your VAT inputs and you deduct your VAT output and inputs, you arrive at a net position, either a positive position. You have a deduction that you can reduce your exposure to the government by virtue of the fact that you have a VAT gain from them. So the direct expense trap, or the cash flow suicide, basically saying that you can only claim input VAT. That's what we had before, on products directly related to, on expenses directly related to your products. But you usually cannot claim input VAT on overheads like office furniture, etc. But that's not the case anymore. Now, anything that is input, anything is input VAT. You just need to have your records and evidence to show that, I incurred VAT when I was buying this thing, I incurred VAT on that. And then you arrive at a net VAT minus input minus output position, and you apply it to your CIT exposure at the end of the year, because again, you had previously incurred that VAT. And you remember that VAT is deducted at source. So it's not a way of, I want to hide it or I want to reduce my VAT exposure. It's not possible. Your VAT exposure has already been done. So services that are tax exempt, based on 2025 tax reform, the structure of the VAT regime, we now talk about exemptions. So it applies on two things: who is exempt, the person, and what is exempt, the product. So a small business is now VAT exempt. If your business annual turnover is less than 100 million, forgive me on this slide, you're exempt from registering for or charging VAT. But again, it's not automatic. You need to provide evidence that your annual turnover is less than 100 million. So you don't just so the implication is that you don't need to add 7.5 to your invoices, right? But you should still file your monthly VAT. You still need to file it, even if it's new. Still file. So if you're exempt, you cannot just claim input VAT as a refund, and the VAT you pay to your suppliers is a sunk cost. You don't get it back from the government. On goods and services that are now VAT exempt, again, if your annual turnover is greater than 100 million, you don't charge VAT on these services. So zero rated or zero exempt medicals products, basic food items, educational items, baby products, fertilizers, and exports. The idea again is to reduce the cost of living and make this thing. So the objective is, if these things are cheaper, there's a reduced cost on it, because VAT is 7.5%. So if I've removed 7.5% of the cost, you should sell it cheaper to people. But remember, what we're having is a lot of panic, and people are saying to themselves, is it not going to be added back, or who will now pay? There's a lot of confusion in that VAT application space in the air right now. But the objective is maybe 1 or 2 years down the line, when the law now becomes more clear, right, we will now start to see the impact of some of these applications, when people are seeing that, there's actually a 7.5% savings I'm getting here, or maybe previously my cost of production was high, but now I'm getting some tax exemptions, so I should invariably reduce my costs. The energy exemption, so to support the transition to clean energy, so things like your solar, things like your gas infrastructure, which is your CNG or your LPG, those of us that are transitioning our vehicles to CNG vehicles, right? They're trying to say that you are now getting some savings, so you're going to reduce you're exempt, so you can use that as a cost savings, not an allowable deduction on your cost of operations, because you are now transitioning to clean energy. So summary of a checklist that I want us to do on Monday morning is, first of all, check, are you definitely under 100 million? Forgive me, this slide is old. Then if yes, you should stop charging VAT immediately. check your products. So do you sell items that are VAT exempt, food or meds? If yes, ensure that your invoice lists VAT as 0. And then do not confuse exemption with 0%. Exemptions means that you don't charge 100 VAT and you cannot claim VAT back. But 0 rated means that you're zero VAT, but you can claim VAT back. Another thing I wanted to mention in this meeting is on your invoices as a business owner, please ensure you include your tax ID when you're filing, when you're submitting your invoices, because that tax ID, I've seen it happen time and time again, where some invoices don't have tax ID included on them. That is wrong. If your tax ID is not included on your invoice, how do you expect people to remit your tax ID to you? How do you expect to have a track record of your tax ID with tax authority when that information is not readily available to the taxpayer? So please check your invoice. Is my tax ID on it? If your tax ID is on it, not on it, please make a change and have your tax ID written on it clearly for your payments, that's your deductions on your invoices, to be able to be remitted to you. And there's also a place where if you don't have your VAT, that is the business that is now trading with a person who has not registered that's not registered with the tax authority and does not have a valid tax ID, there's now a 2% charge that they will not be paying, because they're saying that you clearly want to avoid the law. So tax evasion, again, not being encouraged and being corrected. There's a penalty for not, as a business owner, for not having a tax ID. So what is WHT? WHT is basically an advance payment on your income tax. It was invented because the government didn't trust people to fully declare their full income, right? And they said to themselves, oh, let's start deducting at source. At the end of the year, we would match it up. If people have over or under deducted at the end of the year, we will correct it and we would use that against their CIT filing, right? Their CIT filing. So if you have an invoice, there's now a WHT deduction that now applies on it, and it will be used in the future against your CIT. So it's not a dash money, it's still your CIT, but you are prepaying your CIT. You can still claim it as a receivable and use it to reduce your tax exposure, right? So the gross up myth, where many vendors said, I want 1 million debt, so if you like, they will still bill you 1.1 so that you deduct that exact 10% and they will still get their 1 million. Is not encouraged any longer. It's not, you will still get your 1 million. It's just that a portion of that your 1 million, the government has gone to say, I want to keep it now. And eventually, when you now file your PIT, you use it to reduce your CIT exposure. So you see invoice instance before CIT or WHT, right? Such instances will not be encouraged any longer, and the invoice is automatically assumed that VAT and W can be pre-applied as a credit note to get your CIT when you're filing. The agency dilemma. So in 2026, we now have this dilemma on certain what's called certain sectors where you are exempted. They've exempted certain small business owners from low margin transactions from WHT to prevent capital erosion. But you must check if your specific manufacturing sector has been exempted. Do not let clients deduct WHT if the law says you are exempt. So if the law says you are exempt, so for instance, people in some of these sectors, right, we have the tax rates applicable to them. People in construction business, you have 5% applicable on your WHT deductions. Professional fees, they exempted professional. So before, professional fees, the reason why the government included them in the bracket is they assume that for professional and consulting fees, right, you are knowledgeable enough on the law and you can do some sort of tax evasion and avoidance. So intelligently, they've now pulled them into the pool. So contract and supplies, you now have your withholding tax at 5% and dividends, rents, and interests at 10%. So this is the last slide on this presentation. Thank you so much. We'll go to questions after this. So winning the business war requires 3 tactical moves. Number 1, know your bracket. If you're under 100 million, keep your documentation so that you pay 0% CIT legally. You should also segregate your VAT. Never treat VAT as your money. It's a debt that you owed for 21 days and you have to remit to your government. So you should get the need for getting on-team withholding tax credit note no longer applies, is now automatic, and it will even be sitting down your Tax Pro Max portal. So that's it all for now. There's the next session, but this meeting will definitely have another session where we'll go further into more insights and more details on this matters. Thank you so much. I don't know if you have any questions to ask. I see my chat box really filled up.
Wow, thank you so much for that powerful session. There was just a whole lot to unpack. Wow, thank you so much. More strength, more insight.